So I wanted to start out tonight by explaining the process by which this bill goes after when we get to it and I get to read it. So the Congress complies, votes, gives the bill to the president. The president then signs it. And so it was the one big beautiful bill, and as soon as Trump signed it, it was the One Big Beautiful Bill Act. That goes to the IRS. They are then taxed with reading the tax portions of it, which the bill is about 930 pages. And of that, about a third of it has to do with taxes. Part of it has to do with the massive military spending. Part of it has to do with Medicare and Medicaid, which is not really a tax issue. Part of it has to do with infrastructure. So but about a third of it that deals with taxes. So the IRS gets that. And then it's up to them to write the code that goes with that bill. Now they're going to read the committee reports. They're going to read the act itself. They're going to talk to the senators, and they're going to try and get a sense of what was intended in the writings. And that's what they're going to put into code. Now that code is going to become a temporary regulation. A temporary regulation can be a temporary regulation for forever in some cases. But it can be there for a while, for sure. And it's going to get changed over time. They'll find errors. They'll find, things that aren't correct. They'll find things that'll get challenged in court and get turned over. So what that bill says is maybe not what the final code and regs will say. It's important to issue when it's important to issue that have a material monetary concerns. So when something goes into temporary status, and this has happened 3 or 4 times in my career, so not a lot. My career has spanned 45 years. When something goes into temporary status, and it could later have a material effect on your tax return, as there might be some things in this bill, in this act, what we'll do is every year before it becomes a final regulation, we will file a separate form that will leave this year opened so that we can go back and amend the original year. Now, usually you can only go back 3 years from date of filing, but this form allows us to go back for as long as we file it every year, for as many years as it takes for this act to become, the regulations to become final and leave temporary status. There'll be, as I say, some parts of this act definitely would fall into that category. So when we're talking about doing your taxes, or if you're talking to somebody else about doing your taxes, make sure that they're aware of the changes and the things that are temporary and the things that aren't. Okay, so we're going to go through the 2025 changes, things that are going to apply to this current year first. And then I'm going to go through the 2026 changes. And other than to say that the changes to Medicare and Medicaid don't take effect until 2027, I am not going to discuss the changes, other 2027 and beyond changes, because they could be totally rewritten between now and when they occur. And even if something has been made permanent in the code, that never means permanent. I mean, they can always have a congressional act that would change a permanent status. So if you don't like something, write your senator, congressman, and let them know that you have concerns. Anyway, so and back in 2018, when Trump did his first tax act, he put in a high standard deduction, and then they put in the SALT limitation at $10,000. The SALT limitation being the maximum amount of income tax, sales tax, property tax, you name it, with the exception of the arts tax, that you could deduct on your itemized deductions in any one year. So it made it so that most people that would have itemized that their standard deduction was greater and they no longer itemized. So this year they've raised the standard deduction for married filing joint to 31,500, which if somebody owns their own home, so they don't have a big mortgage, interest deduction, chances are that's going to cover their itemized deductions. Well, they could have unusual medical, or they could have unusual or higher charitable giving. But most people still, I think, will end up filing standard deduction. Married, 31,500, single, 15,750, head of household, 23,625. And this is, as I say, all these are effective this year, this filing season. I'll give you the dates where these changed, because not all of them are for the full year. Some of them are date of enactment, which was July 4th. Some of them are later, and I'll give you those dates. So as I said earlier, the SALT limitation was $10,000 maximum tax of basically any kind that you could write off on your tax return. But with this act, that number has been raised to 40,000. It's kind of interesting, because this is one of the holdups that really drug it out and made it so that this bill wasn't passed 2 or 3 weeks earlier, because there was a lot of fighting about how this would work. A lot of the senators did not want, or congresspersons, both houses, did not want the tax number to raise above the 10,000. Others wanted it at 30, others at 40. Obviously, the 40 got there. So that's for a married filing joint return, or a single return. For a married filing separate return, it's half that. It's 20,000. Now, if looking at my notes here. Oh, in 2026, that number raises with inflation to 40,400. So itemized deductions do phase out. People are going to lose, they're going to be reduced by 30% of the taxable amount in excess of 500,000. So they don't phase out very early, and they can only phase out down, the taxes can only phase out down to 10,000. So they still get the minimum SALT deduction. One of the new things for this year, for those people who are old enough to remember, we used to get to write off car interest and credit card interest and homeowner interest. Well, we don't get the credit card anymore, but this year they're putting back in the car interest. You get a write-off up to $10,000 of car interest. That takes effect for any debt incurred after 12/31/24 on a first lien. So that's all of this year on the first lien. It does exclude fleets and commercial vehicles, lease. The maximum amount you can deduct on a lease is 10,000. This is all phased out for $200 for every $1,000 over 100,000 for a single, 200,000 for joint. The vehicle has to be made for standard roads. It has to have at least 2 wheels, so no unicycles, and a gross vehicle weight less than 14,000. And the final assembly had to take place in the US. So if they ship in the car and all of its parts, but they leave the doors off, this is something that's not been defined. What is final assembly? Do we just have to put the doors on in the US, or do we have to, put the engine in? Nobody knows. That's one of those things that will get written in the regs. And it also includes refinancing an existing automobile, but it cannot be from a related party. So you can't loan your child, or they can't loan you the money to refinance, to pay off an existing debt and then refinance it. But if you refinance an existing vehicle, say you bought it when interest rates were higher, and you are able to refinance it now at a lower rate, that might make sense. But you would get to write off $10,000 of that vehicle interest. Some of the things have been talked about a lot in the news. So overtime income. So, and this is, there's a lot of catch-22s in this one. So overtime income, if you're single, you don't have to pay tax on $12,500. And if you file a joint return, you don't have to pay tax on 25,000. Now that's what it says. It doesn't say that one of you has overtime of 25,000 and the other doesn't have any overtime. It just says overtime, and you get a write-off 25,000, you don't pay tax on 25,000 of total income on a joint return, total overtime income on a joint return of 25,000. So that's one of those things that's gonna get written, and the regs will get written and they'll be temporary and might not be settled for a while, because it's probably gonna be a court case before that one gets finally settled. And you reduce that by $100 for every $1,000 of income over 300,000 for a single person. You reduce it $100 for every $1,000 over 150,000 for a single person, 300,000 for married filing joint. If you file married filing separate, you don't get any overtime for free. So tips. You get a write-off and not pay tax on the first $25,000 of tip income, but in specified industries. They've specified about 8 industries in the act, leaving it up to Congress to add industries. So they've said, hairdressers, waitresses, hotel keeper, bar maids and whatnot. Those are all standard industries that get tips. It's for W-2 employees and self-employed. So last year when they were talking about this, my goat shearer was out here and shearing my goats, and he charges me $250 and I give him a 20% tip. So it comes up to $300. So I said, well, Johnny, next year you can charge me $200 and I'll pay you $100 in tip, and you won't have to pay tax on any of that. Or maybe 150 and 150. We'll see. We'll see what the government would allow when they get that act written. And it looks to me like Johnny would have a pretty good argument if he charged me $200 and I paid him $100 tip, and he would not pay tax on that $100. And I have no problem doing that at all.
Good for her.
Now this is also phased out for $100 for every $1,000 over the 150 single return, 300,000 married filing joint. Once again, you have to pay tax on all your tips if you're married filing separate, and you have to file married filing joint if you're married for this provision. So that's going to be interesting to see how that works. It's the same thing with overtime. If somebody normally makes $60,000, do they go to their employer and say, hey, pay me, 45,000 and I will get 15,000 tax free, and we will just adjust my hourly wage. You can tell them I was a crappy employee and that's why you did it, and I'm going to get a benefit and you're still going to get the same write-off. So something to think about. So child tax credit was $2,000 per child under the age of 17. It's bumped up to $2,200. And the biggest change is that it's per child, and the $1,400 of that is now refundable. They changed the adoption credit. It was you could write off up to $10,000. I think it was $10,000 of your adoption expenses. But if your income, if your tax was, and it's a credit, so it's against tax. If your credit was only, if your tax was only, $6,000, you could not write off in any way that other $4,000 if your adoption was complete, or get it back. But they've now said if your amount of your credit exceeds your tax, you can get back a refund of up to $5,000 depending upon what your adoption, there are some caveats there, but there is no income caveat on this one. 529 plans had a lot of changes. These are plans that for saving for college or some other trade school, that anything that basically would qualify for a federal loan. So they've changed it in a couple of ways, and we'll talk about the first way, and then later on we'll talk about the second way. But it used to be you had to be going for a degree. Your intent was to graduate and get a degree of some sort. But the biggest change is that now you can use it to obtain or maintain a certification program. So like my CPA certificate, when I sat for the exam, not only was the training for the exam really expensive, and now it's like 10 times more, but the cost of the exam itself was expensive. And now you can use the 529 for those costs, which I think is a really good thing, and will certainly help a lot of people, because when you're studying for those exams, you don't have a lot of time to work. And so trying to come up with the money to live and pay for those exams and the studies. And this one is effective date of enactment. So this is for July 4th expenses going forward of this year. Businesses, there's a few changes to businesses. I'm going to mention the ones that I think actually would be pertinent to most of the people on the call. The tax rate for corporations, we made the same at a flat 21%. Kind of ridiculously low, but I'm not going to tell them to charge me more, because they didn't believe me on any of the other things that I suggested. So expenses, you can now expense, let me back on a bit. 4 years ago, you could expense 100% of the cost of equipment, plant and equipment that you bought for your business that had 20-year life or less. And then that kind of dropped down and dropped down and dropped down, and it was due to expire entirely in 2028. Well, they put that back up to 100%. So if I go out and buy computers, desks, chairs, somebody, in manufacturing goes out and buys, $1 million worth of equipment, they get to write off that whole $1 million in the year purchased. As long as it's a valid purchase, it doesn't even have to be placed in service, is what it looks like, although placed in service has always been the criteria. The other big change to businesses is that 4 years ago, 6 years ago, it came in that you could only write off business interests to the extent of income, and you had to take into account depreciation, amortization, all of your interest expense, and a couple other really non-existent, kind of air things. You don't have to do that anymore. You can eliminate all those things, so you get a write-off a much larger amount of business interest than you've been able to in the last 4 or 5 years. And what they're trying to do, of course, is to incent people to borrow to build those plants, so we can have massive manufacturing sometime by the end of next year. And they can only do it if they have the cash. And a lot of companies, even though they may have the cash, they don't want to spend down their cash because they aren't sure what's going to happen with tariffs. So this is a way to incent people to ignore the tariffs. So the other business item is called qualified business income, and it's a 20% deduction. So if I have 100,000 of income net profit on my company, I get a $20,000 write-off on my personal return because I'm an S corp for my business interest income. And this was due to expire this year, and now they've made it permanent in the law. So you guys you probably don't know it, but most of you actually have this on your return, because when you have dividends, you usually have a 199A deduction. And that 199A deduction is the qualified business income deduction. So if you have a little bit of dividends, particularly if you've got any kind of real estate in your portfolio, but almost any business, it's gonna pop up and it's gonna be there as a deduction against your income before taxes are calculated. And one of the other big areas is, and this was an interesting one, research. We used to call it research and development, R&D expense. It's now called research and experimental expenses. This went in 2020, in 2021, the law changed and you had to start amortizing this over 5 years. You couldn't just write it off. Prior to that, somebody spent money on R&D or R&E as they call it now. You just got the write-off in the year that you spent the money. And then you had to, in 2021, you had to start writing it off over 60 months. Well, beginning in 2025, you can write it off again. You can write off the unamortized portion of what you've been amortizing over 1 year or 2 years, your choice. So 2025 and 2026, or just 2025. And any expenses in the current year and going forward, you can write off in the year that you expended. And I'm going to mention this next one because we have several people who have corporations, and I think that if unemployment goes up, there'll be several people that will start businesses in the next couple of years. So when you are forming a company, if you choose to make that company a C corporation, you can elect to have your stock issued under code section 1202. 1202 stock under the old laws that have since expired. If you held that company for 10 years, and there were some other caveats, but you couldn't have more than, I think, 10 owners and a few other things. If you held that company for those 10 years and then you sold that company, that stock, when that on the sale, that was tax-free. Then they did away with 1202 stock a few years ago, and now it's back. And it's back in a really meaningful way. Now keep in mind, it's only C Corps. It's not partnerships or LLCs or S Corps or individual companies. But if you hold that stock for 3 years, you can exclude 50% of the gain. If you hold it for 4 years, you can exclude 75% of the gain. And if you
Are you
hold
interested in
it
this?
for 5 years,
I'm waiting to see if
Can
there's
somebody
anything
please
that
mute
seems to
themselves?
be
Please,
relating for you.
please
The
stop.
first part was
Please mute
as
yourself.
far as standard deductions.
Please mute yourself. Whoever's talking, please mute yourself. The maximum amount of gain that you can exclude is 75 million. That's not a bad piece of gain for a small business. And this, once again, is effective for stock issued on or after July 1st, 2025. Now, investments. There is an item called Opportunity Zone Funds. You can invest in an opportunity zone in a couple of ways. You can buy into it with cash, or if you sell highly appreciated stock, you can take that gain. If you do it within, I want to say 180 days, it might be 90 days, I didn't put that down, and invest that in an opportunity zone fund. You can defer the gain for up to 5 years. And at the end of 5 years, you get a 10% increase in your basis every year for those 5 years. And your basis is assumed to be 0 for all intents and purposes. Now, and if you hold that opportunity zone for 10 years, all of your gain is tax-free. So an opportunity zone is an area that has basically impoverished. They have at the poverty level or below. Their median wage is less than the median wage of the area. Rural versus urban has some differences. And you invest that money and you just leave it alone, then all of your gain at the end becomes tax-free gain. And this is effective as of July 4th, 2025. You can see dates are all over the place. Now, some things that are taken away, which are almost as important as things that they're giving to us. Effective September 30, 2025, there is no more electric vehicle credit. Not for used electric vehicles, not for new electric vehicles. It goes away. So if you were planning on getting an EV and you wanted the $7,500 credit, or the 5,000 in some cases, you have to have completed that sale and taken delivery by September 30, 2025. No, right around the corner. You don't have much time. There is no commercial EV credit after June 30, 2026. So if you are a business and you are buying a fleet and you want EV credit, June 30 of next year is your last day to get that credit. No energy efficient home improvement credit after the end of this year. So if you were planning on putting in energy efficient doors, windows, walls, anything of that nature, at the end of the year is the end of that credit. And it's not a bad credit. It's a 12% credit, I think. So if you're going to do it, you have to do it right now. If you were planning on putting solar on your house or wind or geothermal, end of the year, December 31, 2025. If you were planning on making energy efficient improvements to a commercial building, June 30, 2026. If you were planning on buying an energy efficient dishwasher, stove, washing machine, what other appliances are out there, that credit ends June 30, 2026. So you don't have a lot of time to get that done. Now, the last thing in the 2025 area is that they increased the debt level. There's a lot of, this is another area that had a lot of controversy. You had Rand Paul that wanted no increase. You had people that wanted $3.5 trillion increase. But what they ended up with was a $5 trillion increase in available spending. Kind of interesting when they're firing everybody in the Department of Education and Health and everything else. So now let's talk about 2026, which has as many changes, if not more. Estate and gift tax, not counting the 19,000 annual gifting limit. So the total amount that you can transfer either via gift or at death, the total amount that you can transfer over your lifetime above the annual gifting amount is now $15 million. Now this is for US citizens and their US citizen spouse. If you are a US citizen and your spouse is not, and play that either way, husband or wife, doesn't matter. If one of you is not a US citizen, you do not get unlimited transfers between spouses. And that 15 million is per person. So if you have change something, I had a typo there. If you have a married couple and they both die, that's 30 million of transfer. If the first one dies, they can transfer their entire estate to the second one, as long as when their estate return is filled out, the little box that says check here for portability, the second spouse has $30 million or whatever's left of that amount for her to transfer at death. So, and maybe I probably need to explain that. So husband has 15 million, wife has 15 million. Say husband only has 5 million on his death, and and he transfers all, well, say he's got, 5 million, and he transfers that to his spouse who has already 5 million. So now she's got 10 million, and she lives several years and that grows to 30 million. Well, he had 10 million left on his transferability. She has 15 on hers, so that with portability, she would have 25 million that she would not have to pay tax on transfer at death, and there would only be 5 million that she would need to pay tax on. So if somebody dies, just make sure that they check that little box that says you want the portability feature. Now, for non-US citizen spouses, if one of you is not, there is no unlimited transfer. You don't get that you each get the 15 million, but you don't get the portability, and anything that transfers to the spouse that is above that 15 million is fully tax, well, anything that transfers to the spouse that isn't covered by the estate return is fully taxable. So just make sure that when you're looking at that, if you're not a US citizen, and I know this is a really touchy subject right now, if you know somebody that's not, this might be a really good reason why they would want to become a US citizen before they die, although that probably is off the table for the next 4 years. But this is effective in 2026. Few years back, when people were buying houses with 5% down or nothing down, they would have to pay mortgage insurance, and that's kind of like throwing money out the window driving down the freeway. But if you don't have the 20% to put down, you get nailed with mortgage insurance, and it's kind of expensive. And for a number of years, you were able to write it off under the interest category, and then that expired 4 years ago, but it's back. So you can now write off your qualified residential mortgage insurance premiums as interest on your itemized deductions. And this may be one of those things that really pushes the itemized deductions up over that 31,500 limit, or half that for single. It also is to incent people, the tax code is written almost entirely to try and incent the American population to do what Congress wants it to do. And what Congress wants it to do is to buy houses and cars. Hence the car interest deduction, this mortgage interest deduction. You don't have the money to put down on a house that you should have, but you can indebt yourself twice the mortgage normally would be, so you can buy that house instead of waiting and saving the money. So, but Congress is definitely trying to get people to buy houses, because that's one of the parts of the economy that's really faltering. Now, it used to be, before 4 years ago, we had something called miscellaneous itemized deductions. Those were writing off the cost of your tax return, writing off my management fee, writing off a PO box. If you took continuing education that did not qualify you for a new or higher paying job, you could write that off. If you did a job search and had to travel for interviews, you could write all of that off. Well, with the OBBBA, miscellaneous itemized deductions are no longer in the law. They are permanently excluded. And the only thing that you can write off now is educator expenses. It's an itemized deduction. It was on the front page, but they apparently moved it to itemized deductions, or at least that's the indication, the way the bill's written, but it's always been a front page below the line deduction. So this is kind of interesting that they've totally eliminated all these possible deductions, but most people didn't use them anyway, because it had to be more than the total of all those, had to be more than 2% of your adjusted gross income. So then we take Then we take and we say, okay, well, here's your itemized deductions. These are all the things plus medical that you get to write off. But you're gonna get limited if your income, you lose 2/37 of the amount that your income is over the 37% tax bracket, which is 500,000. So, I'm thinking that for people who earn 500,000, they probably don't really care, but 2/37 is not, much. Now, gambling winnings and gambling losses. I thought this was really interesting. Gambling winnings and gambling losses gambling winnings have always been a front page reporting as other miscellaneous income, and gambling losses have always been an itemized deduction, but not miscellaneous. You got to write off the whole thing. You could write off your losses to the extent of your winnings. Now you have to report your winnings, but you only get to write off 90% of the losses up to the extent, right? So if you have winnings of 100,000 and losses of 100,000, you used to be able to just zero them out. Now you would have winnings of 100,000, you would have losses of 90,000. So they're going to get some income off of gambling, even if it's minimal. Thought that was kind of funny. You can roll over, yeah, effective 2026. If you have a qualified tuition program, which would be a 529, you can roll that into an ABLE account. An ABLE account is an account, a savings account for disabled people. That's not really what it stands for, but it's been in the law for a few years now, and this is now permitted so that you can, if you have somebody that has an ABLE account works with SSI, Social Security, works with there's one other thing it works with, but the whole stupidity of this is if you've been funding money into an ABLE account for the last 4 or 5 years, and you've been putting money into a 529 plan, and now you can roll that 529 plan into the ABLE account, but if that ABLE account's over $100,000, you don't get the SSI. So I don't know why you would do that, but I'm sure there's some valid reason Congress thought of. I thought this was very interesting. And maybe a planning function. If you have student loan debt and you die, your loan is forgiven. So if you are terminally ill, I would really recommend you don't pay it. If you think you're going to die in 2026, it'll all be forgiven. That's one of those really bizarre planning points. Now, I don't know how many people have heard about the Trump account. The Trump account falls under the same code section as IRAs. It is an account, and there's lots of caveats to this. The person that is going to the beneficiary of the account has to be less than 18 years old when it's funded. It can be funded by a qualified rollover, which they don't really define where that money is rolling from, but I think probably from an IRA. But if you are old enough to have an IRA, you may be over the age of 18. Or it can be funded with cash. When you set it up, it must be designated as a Trump account as it's being established. The first contributions cannot be made until 12 months after enactment, so not until July 4th of 2026. There are no distributions until age 18. It can only be invested in a qualified index, no leverage, and the annual management fee has to be 0.1% or less. The contribution limit in any 1 year is $5,000, and it's not deductible. You can put in $5,000 a year into your child's account. You get no deduction for it. I'm not sure why well, there's some planning things around children and working and can roll the Trump account at age 17 into an ABLE account. And once again, why would you do that? Because you're going to end up pumping that ABLE account over 100,000 and limiting all of their other deductions, all of their other benefits. Your employer can make a $2,500 contribution to the employee's child's account, Trump account, on an annual basis. It does count toward that $5,000 limit, and it is not income to the employee, and it is deductible by the employer. The government will put $1,000 into every qualified and into every Trump account for a qualified child born between December 1, 2025 and December 31, 2028. So everybody get pregnant so we can all get that $1,000 per year for 3 years, because it's a little late for the 2025 one. The earnings will grow tax deferred, but when you pull that money out, it is fully taxable. The beneficiary must be a U.S. citizen. And so this is one of those things that birthright citizenship is going to, kind of hang on. If birthright citizenship stays in place, then, and the child's born next year, the government's going to have to put $1,000 into a Trump account for it. If birthright citizenship does not hold, they don't. So this is kind of an interesting one to watch. Now, dependent care assistant program. So if you're an employee and your employer offers a Section 125 plan or called a DCAP plan, you're able to have $5,000 withheld, income tax free, not Social Security, but income tax free, withheld, and then you present to your employer the cost of childcare. The employer writes a check either back to you or to your provider, and then that money is tax free. Your childcare is now tax free. Then it was $5,000 on a married return and $2,500 on a single return. However, in reality, I have never seen one that was less than $5,000, so I didn't even know the $2,500 existed. That is now bumped up to $7,500 and $3,750. Child dependent care daycare has been increased to 50% from 20%, but it does phase out pretty fast at $75,000 and $150,000. So if you're in that category, I think you just come talk to me or send me an email and we'll talk about it. Now, this is an interesting one. If you give money to a scholarship program where the scholarship is for elementary or secondary education, you can take a credit on your taxes for a maximum of $1,700. Now, it cannot be a program where your child is the only child. It can't be a program where, there's 5 kids and yours is one of them. That's too small. But if you send your child to away to college, then you can, way to elementary school or secondary education, private education, and you happen to contribute to the organization, if they're a 501c3, then you can take a $1,700 credit on your taxes. If your employer pays your student loan up to a maximum of $5,000, that money is excluded from the employee's income and fully deductible by the employer. Not a bad deal, because I know that most employers, I think, would not, if they could afford it, I think they would want their employee to not have student loan debt and would probably help out. Now, up until this, you could take $10,000 of your 529 account and pay $10,000 child's elementary or secondary education, tuition. You could pay it for their tuition, materials, books, online materials, tutoring at a public place. And that school can be public, private, or religious. And the religious is the new element here. But instead of $10,000 going, you can pay $20,000 for pre-college education. There's some, they made permanent the low housing credit, low income housing credit. They made permanent the extended new market credit. Most of you aren't gonna worry about. There's a few people in partnerships that will have low income housing that was due to expire, but it's not going to now. So back during COVID, they allowed us to write off, I think it was 500 and 300. If you didn't itemize your deductions, you could write off that as a separate line item on the second page of your tax return. If you did contributions, wasn't a lot, but at least it was something. Well, they've now put that back in the law. So if you don't itemize and you're single, you can write off $1,000. And if you're married filing joint, you can write off $2,000. It would appear that married filing separate does not get to write off any. Now, this is the one that I really kind of scratched my head over. Charitable contributions. Now, the government is, should be highly in favor of charitable contributions because what charities pay for, government doesn't have to. But now, on an individual return, if you're making charitable contributions, you have a floor of 0.5% so that you cannot deduct. Not a lot, but it's kind of a foot in the door. Excuse me. Maxine, stop it. So it's kind of interesting that they would not allow you to deduct all of your charitable contributions, and it gets limited basically charitable type by charitable type. So if you're a corporation, you have a 1% floor. You've never been able to deduct on a corporation more than 10% of your profit, but now you have a 1% floor that you can't deduct, and you still can't deduct more than 10%. I thought that was kind of counterproductive. So for those of us that are in business, we get the pleasure of filling out 1099s for anybody that you pay more than $600 to, or any rent or any lawyer fees. This has been $600 has been the amount for as long as I've done taxes, which, as I said earlier, was 45 years. They have now raised that amount to $2,000. So, you hire somebody to come in and do some filing. It was a 1099. Now it's not a 1099 until after you paid them $2,000, which I think is a really good thing because it's been pretty ridiculous. I thought this one was pretty interesting too. The old law was every time a gun was sold, the vendor had to pay a $200 firearms tax. The new law is if you sell a machine gun or destructive device, the vendor has to pay a $200 tax. Any other gun, $0. So that was I'm sure a nod to the NRA. That's effective. The wording here is really funny. Effective for calendar quarters beginning more than 90 days after enactment. Well, 90 days after enactment would be like October 1st, which means it really won't be for the quarter ending. So it really won't be effective until 26. Starting in 2026 for businesses that take debit or credit cards, they now have to pay a 1% tax to the government for the privilege of using debit or credit cards. And I think one of the biggest changes is to the student loans. It's very, very convoluted, but the maximum student loan total per year, the maximum student loan for a graduate degree that a person can take out per year is $20,500. That doesn't even cover a term. Maximum professional student loan, $50,000. So if you're in a professional program, you can borrow $50,000 a year. If you're in a graduate program, $20,500. The total aggregate for graduate studies is $100,000. The total aggregate for professional studies is $200,000, effective June 30, 2026. And they are now saying that everybody that has student debt has to be on one of two repayment programs effective July 1, 2028. You have to choose your program and stick with it. And being out of work or having no money is not an excuse for not paying. And there's also some changes to Pell Grants effective July 1, 2026. Okay, that's it. Unmute yourself or send me chats in the chat box.